Okay, so we're gonna explain how we're gonna account for the issue of common shares and preferred shares. Okay. So issuing common shares. So basically, the shareholders will pay some cash, pay the money to the corporation in exchange for their shares. Okay. So in this situation, there are two accounts. I want to see if you guys understand. There are two accounts for this transaction, accounting transaction. There are two accounts involved. One is cash, one is common share. So I want to ask you, what does this cash belong on the statement of financial position? So it could be asset, liability, or equity, right? So tell me which part of that statement does the cash belong? Is it asset? Is it liability or equity? Current asset. Very good. Okay, very good. So that's the asset. What about the common shares? What does this common shares belong? Asset, liability, or shareholder equity? Okay, very good. Shareholder equity. Okay. So now let me. I need to use my pen. I need to draw something on my screen. So I have to do this. Okay. Hopefully I can do it. So you have, here is the asset. Remember the accounting equation equals liability plus equity. So I use the first letter of the word. This is a short term. A equals L plus E. Assets equals liability plus equity. Okay. And you told me that the cash is here, right? Cash is here. And common shares is here. Okay. So suppose they issued $100 worth of share. Okay. So from the corporation's perspective, does their asset, their cash increase because shareholders gave them $100 to buy the shares? Does the corporation's share, the cash or the asset increase? Yes. Okay, good. So it's increased, right? And by how much? Increased by how much? $100. Very good. Okay. So now the left side of the equation, this number is higher, is $100 more higher, right? So to keep it balanced, this equation has to always balance. The right side, this side, has to also increase by $100. So where do you think that happened? So which balance has increased $100? Correct, the equity. So for some students, you don't see this because students are replying to me. They send direct message to me to kind of interact with me. So it's equity, right? Particularly the common shares increased by 100. So from this example, you can see this is accounting transaction, okay? So through the transaction, things will change, right? In this situation, asset increase $100, equity increase $100, liability doesn't change. So the equation are still balanced, okay? When you add the same weight to both sides, right, of the weight scale, it's still balanced. Okay, so how do we using the accounting language to record this transaction, right? So basically, we use double entry, right, system. Accounting, we call it a double entry system, okay? So what we are doing, we are saying left, right, right? So basically, we are saying we define the increase to the left side, okay, to this left side accounts. We call it a debit. And the opposite, okay, the opposite is the credit. So I don't want you to read too much into the terminology. You probably are thinking about, oh, I have a debit card, I have a credit card, right? That's how I was trying to think of this when I was a first year accounting student. But don't think that way. Just think about these two are opposite, just like left and right, black and white, right? Front, behind, positive, negative, right? So, in our world, we have a lot of these pairs of opposite terminologies, right? So debit, credit means opposite direction, okay? For asset accounts, okay? For asset account, if I say I debit cash, okay, I debit cash, that means the cash is increased, okay? So you can see here, DR, that means debit, okay? So if you say debit cash, so that means, and this cash is asset. If I debit my asset, so my asset increase, okay? So that increase is $100. Okay, now, if I debit my liability and my equity, it creates the opposite effect because these two accounts are on the other side of the equation. So if I debit my asset accounts, it's going to increase the asset balance. But if I debit my liability account, equity account, it's going to reduce their balances. Their balances will decrease, okay? Now, you can see here, credit, okay, credit. If I say I credit my equity account, common shares, that means that account balance will increase, okay? So in this case, I debit my asset and my credit my equity, okay? And the debit balance is 100, credit balance is also 100. They are equal, therefore it's balanced. So for every entry through debit and credit, I'm keeping that equation balanced all the time. Okay? Does this make sense? If it's not, we're gonna do more about this, okay? We're gonna have a lot of accounting entries. We're gonna do a lot of more on this. So for now, just think about debit applies to the asset account. So it's going to increase it, okay? If you credit an asset account, it's going to decrease it. So we're going to talk more about this. Okay. Now, let's move on. Shares can be issued in exchange for service or non-cash asset. Okay, so sometimes they could issue the shares for in exchange for other things. Okay, and then that accounting rules are different depending on IFRS or SB. It's going to be beyond the scope of the course. Just for you to know, it's not always a share for cash. It could be share for other asset or service. Now, repurchase common shares. Okay, repurchase common shares. Company issue the shares to the shareholder. The company can also buy it back. We call it a repurchase. Okay. So why are they doing that? So they are giving the cash back to the shareholder. Okay. And because when they are doing these actions, they are increasing the activities on the market, right? So in order to keep the stock active, right? If you notice the trading volume is pretty low, well, the company can be part of it too, right? Doesn't have to be investors. Well, the companies can sell and buy, right? Be an active player to increase that trading volume. Reduce number of shares issued. If there are lots of common shares out, right? If I buy them back, okay, and then I'm reducing the common shares outstanding in the market. And if I have less shares, right, remember that profitability ratio, when we calculate basic earnings per share, you use income divided by weighted average share, number of share. If the number of shares is lower, your earning per share will be higher. Okay. Buy out hostile shareholders, right? So let's say I'm super rich, right? And I'm going to buy all the shares in the market. Okay. So once I accumulate enough percentage, guess what? I'm the boss, right? I'm going to be the largest shareholder. Right away, I have the right to sit in the board of director. I can start firing, laying off some executives. You could have some potentially hostile kind of competitors there. So therefore, if you see they're buying, you are better buying, right? So that you are retaining the ownership, the percentage of ownership, you're retaining your voting right, right? Have shares available for compensation or other uses, right? So you buy them back, okay? Later on, you can give it to other employees in form of compensation, right? So there are different reasons why company want to buy back the common shares. Okay, so now let me ask you, if the company return $100 to the shareholder, what is that entry should look like? What do you debit? What do you credit? If they buy back the share, that means they take the share from the shareholders to them and then gave the $100 money back to the shareholder. So what do you debit and what do you credit? So you debit common shares, credit cash. Yeah, that's correct. So this time, you are not receiving cash, right? You are giving cash away. If you give cash away, right, your asset balance decrease. This time, you're going to use credit, right? Because debit will increase it, and the credit is the opposite. So if debit is increase the cash, now you are decreasing the cash, you credit cash, right? So you're going to credit cash for 100, but this won't be balanced, right? You have to do another thing, right? On its own, this won't be balanced. You have to debit something. What do you debit? You debit common shares, right? So normally, if you credit your common shares, that will increase the common share balance. And now you retire these shares, your common shares decrease. So decrease is the opposite. So you have a debit. So basically, this entry will be exactly the opposite of the last one, okay? If it's not very clear, don't worry about it. We're gonna exercise more on this, okay? So once these shares are repurchased, okay, so they could just retire it, cancel it, okay? They just normally retire it, don't use it anymore, or cancel it. And that will be removed from the share capital account. So the share capital will reduce, the balance will be reduced, okay? Sometimes you can still keep these shares as treasury shares, and in the future you can sell it again. But this is probably not the normal situation. Okay. So how much time do I have left? So 15 minutes. This part, should I teach you now? I'm a little bit concerned. I'm a little bit concerned that maybe this is too much. But I need to try on this. Okay, I need to try on this. Okay, so the idea here is, right? So when you first issue the share, okay, when you first issue the share, you have a price, right? Maybe $10, $20 for each share. And remember that share is on the market, right? And the market price is changing all the time. The market price is changing all the time. So when you buy back the shares, and the price, your buying price, could be different than your initially selling price, right? So then there will be a difference. Okay, there will be a difference. It could be a gain or could be a loss. If you buy it back at a cheaper price, that will be a gain. If it costs you more money to buy it back, that's going to be a loss, right? So this is what we talk about. If you repurchase below the average cost, okay, below the average cost, okay, so, and then what it look like, So in this scenario, you can see that originally you can see that, let me see, to record a repurchase retirement 5,000 common shares. Okay. This slide didn't give me enough information. Okay, so I will write it down for your benefit because otherwise you'll be confused. So this is the information. Just give me a second. Otherwise, it'll be very confusing. So number one, okay, maybe on January 1st, shareholder purchase. Oh, first, the company issued 5,000 common shares to shareholders at $2.50. Okay. So the beginning of the year, the company issued 5,000 shares to shareholders, and each share is $2.50. Okay, and then number two, let's say 30 days at the end of the month, on January 31st, the company bought back the 5,000 common shares from shareholders at $1.50 each. Okay, so that is the question. So let's first take a look at this one. So can anyone tell me what's my debit, what's my credit for the first one? On January 1st, the company issued 5,000 shares to shareholders at $2.50 each. So the company received the cash, right? Because they gave the share to the shareholder in exchange for cash. So the company received the cash. How much they received? 5,000 times 2.5. So they received 12,500. $12,500. This is how much cash received, right? Received on January 1st. What's my entry? What do I debit? What do I credit? Okay, very good. So I go by, I debit cash. Remember, the cash balance increased. So I need, if the cash is asset, if you want to increase the asset balance, you need a debit cash, and that's 12,500. And then if you want to increase the balance of equity, you credit, because the equity is on the other side of the accounting equation, right? So if I need to increase equities balance, I go credit equity. This will be share capital, right? Okay, so it's balanced. Debit equals credit, 12,500. So this would be my January 1st entry. Now we are at January 31st. The company bought back 5,000 from shareholders, and each now at a lower, cheaper price, right? At a cheaper price, $1.50. Okay, so now let's calculate how much the company paid. How much did the company pay on January 1st, 31st? How much? So still 5,000 shares, but they only pay $1. They only pay $1.50 for each share. So together, they actually only pay 7,500 cash, right? So on January 31st, they only pay the shareholder $7,500 cash. And they received the 5,000 common shares, right? That will be retired and removed from the share capital. So if you removed from the share capital, so your equity balance decrease, okay? If you increase your equity balance, you go credit. But if you decrease your share capital balance, you are going to debit. Okay, you are going to debit share capital. And you are going to credit cash. How much cash do you credit? So your cash decreased, right? Your cash decreased. How much is your cash decreased by? Yeah, 70, yeah, 7,500. And you retired all the 5,000 common shares. You retired all the 5,000 common shares. So how much you should debit share capital? Yeah, that's correct. You should retire all of them, right? So in the beginning, you have nothing. After January, you have nothing, right? So the increase should equal to the decrease, right? So in the beginning, you have 5,000 share capital. That's an increase. But now you retired, it's a decrease. So the net effect is 0, right? So basically, you increased by 12,500. Now, because you retired all those shares, you have to decrease for the same balance. But it won't be balanced because you debit 12,500, you credit 7,500. So you don't have enough credit. You have more debit. So you have to debit something else. You have to credit something else. You credit, and the difference is called contribution surplus. That's what happened is the company makes some money surplus by selling and buying stocks. Okay, that's basically what it is, contribution surplus. So that's the $5,000. So this is our first time doing this kind of things, right? I take time. I took some time, slow down, try to explain this. Does this make sense? So give me a sum up if you think it makes sense. Let's go by 1, 2, 3. Give me a sum up. Okay, thank you. So as we are doing more practice questions, and you particularly practice more, the speed will be up, okay? It won't be like this. So first time, I spent time to explain this. So, and you're gonna see this probably almost every class, right? So we're gonna explain this more and more, okay? And why it's, like I said, why it's a contribution surplus? Basically, the company sell the share for $2.50, but buy it back at $1.50. So the company is making $1 profit. I won't say profit, like a gain, right? And 5,000 shares, each $1 per share. That's why you have a surplus of $5,000. So that's your money, right? Therefore, it's equity. That balance increased. Okay, so that $5,000 is part of the shareholders' equity. And we have a name called contribution surplus. Okay, so I think there will be questions on the YD Plus for practice. So definitely work on that. What if the company loses some money? Okay, so that will be the next slide. So then you're gonna debit your contribution surplus. Okay, so you made this 5,000, and next time you may lose that 5,000. So now you have to debit to reduce the balance. Right? Remember, balance can increase, can decrease. You just have to understand when it represents debit, when it represents credit. Okay. So we're going to talk more about this partnership. I'm going to talk about this more. So we'll continue from here, next class on Monday. Yeah, the first assignment will be, that one is already uploaded. Yeah, I will double check, okay? I'm sorry if it's confusing. So I will make sure that the first quiz, I will check all the dates. I will send you guys an email tonight.